In the next section, I'm going to discuss a little bit in more details how people actually trade and access markets in traditional finance. Let's talk a little bit about how people actually trade the equity markets in the US. There are a lot of competing venues and competing ways of accessing stocks. And there are also a lot of rules and regulations that bind everything together. If you're an average retail investor, deciding that you want to buy a stock, there are many different ways in which you can go about it. So you might have a broker. So this would be something like Charles Schwab or Robinhood to access the financial markets. Or alternatively, you might go to a company like Vanguard and have a mutual fund. So a mutual fund is essentially a portfolio of stocks that a mutual fund company packages and then sells it to retail investors or investors for a small fee. Think about going and buying an exchange-traded fund. So an ETF is a portfolio of stocks that instead of being offered by a mutual fund per se, is actually offered by another entity and trades directly on the stock exchange. So you have control over when you buy and sell an ETF. So once the retail investor has decided how they want to access the market, they go ahead, lay down their money, and then what happens? Well, if they go to a broker or a mutual fund, it's quite possible that their order doesn't actually hit the security markets. That order is what we call internalized. So for example, if a broker has a buy order and a sell order in the same stock, they don't necessarily send those both to the exchanges. What they will do is they will act as a mini exchange and cross them internally. However, there are rules and regulations on the price at which they can do this to protect the consumers. But typically, they pick the best price, what is currently in the market. But the main point here is that those orders never actually sees the stock exchange. They're all internalized. Now, if you do actually decide to trade through the stock exchange, in the US, there is something called the national market system. What this is a set of rules and regulations that binds together multiple competing exchanges. For example, NASDAQ, New York Stock Exchange, but also regional exchanges like Boston, Cincinnati, and they get binded on how far apart the prices can diverge. Once an order goes through the national market system and it gets executed, it gets sent off to the DTCC, which handles custody and central clearing of equities and a lot of fixed income in the US. So the DTCC records ownership and is the final word on who owns what. Let's dig a little bit more into the area of competing trading venues. So this pie chart gives you some sense of the different competing venues that you have in the US. So there are 13 exchanges. An exchange is a technical term that is used by the SEC, and it has certain regulatory implications. There are also trading venues that are known as ATS or alternative trading systems. Those are not registered exchanges, but for outside people, they look a lot like exchanges. OTC refers to over-the-counter trades that don't go through the registered exchange or an alternative trading system. Those can be like large trades that are negotiated outside of the public view. They get settled on the OTC venue. Just to give you some sense and some flavor of how a limit order market works. In a limit order market, people who are willing to supply liquidity post orders. Those orders could be either offers to sell or buy. So suppose somebody is posting an offer to sell. They're going to specify a price. So in this case, the lowest price of which somebody is willing to sell is 10.1 and the quantity is 500. Similarly, the highest price at which somebody is willing to buy is 9.9, and the quantity that they're willing to commit to that is 400. So the lowest price at which somebody is willing to sell is called ask price, and the highest price at which somebody is willing to buy is called the bid price. Markets are viewed as being more successful if there is more posted liquidity. This is because if somebody is desperate to trade and wants to trade immediately, if there is more posted liquidity on the market, they can trade a larger volume at a better price with a lower slippage. In a perfect world, with no trading friction, all trades would occur at the fundamental value. So if something is worth $1, you would buy it for $1 or sell it for $1. However, in reality, there are frictions, and we don't observe the fundamental value. The only thing that we observe are the prices at which people have posted limit orders in the past. And so as a proxy that people use for the fundamental value is just the midpoint of the bid and ask price. One other proxy that people use to decide whether or not a market is efficient, whether or not a market has a low trading cost, is what is known as the spread, which means is how far the ask price from the bid price is and how that spread varies over time. Of course, there are more complicated measures in the literature, but roughly they're all trying to capture the same thing. So to come up with a proxy for what we think is the fundamental value. And let's try and understand how much of the markup you pay over that, or how much of the discount you get over when you sell it. Make-take fees. Another source of fees that is not immediately obvious when you trade are what is known as the make-take fees. So those are features of modern markets. I said before that a market is viewed as successful if there is more posted liquidity. So in order to incentivize traders to come to a specific market and to post liquidity, those markets will typically offer traders who post liquidity some rebates. So they will give them money if the order executes. So if the trade goes through, but this is an incentive, those kinds of fees are known as make fees because somebody is making liquidity and they get compensated, incentivized for that by those make fees. If someone comes in and takes liquidity out of the system, making the whole market look slightly worse, they pay an additional fee on top of the price distortion. Those are called take fees because they're taking liquidity from the system. So to give you a sense of the numbers, those are the make-take fees from a few years ago. Those fees varies from exchange to exchange, and there are a large source of revenue from all the exchanges. Now, let's talk a little bit more about the clearing mechanism. So after a trade occurs, everything moves to the depository trust. So the DTCC is an example of a central clearing entity. And the way it works is that every day brokers post margins in order to cover what is going to be their net position. So the reason why they have to post margins or collateral is because at some point the DTCC guarantees that they're going to be the counterparty against any trade. There's also an important function because we don't have instantaneous settlement in securities market, and settlement takes place over a couple of days. So someone has to play the middle ground, to be in the middle, to guarantee and accept the counterparty risk for all the brokers. To give you some sense of what effects a DTCC can have on trades or trade dynamics, I wanted to remember Robinhood and the Gamestop incident. As you know, Robinhood offers zero commission trading. It's not really zero cost, it's zero commission. The reason is that the Robinhood bundles all the trades and sells them, for example, to the hedge funds, and they make money. So at some point, GameStop became a meme stock. So many people were buying GameStop and they were all going in one direction. That meant, as far as the DTCC was concerned, that the Robinhood had a really, really massive net position and they exposed the DTCC to a huge amount of risk. So Robinhood was required to post a higher margin at the DTCC, but because Robinhood were too much of a credit risk, they couldn't borrow enough, and essentially they weren't allowed to increase their position anymore. They had to essentially stop accepting orders for GameStop. I will stop the session here and I'll see you soon. In the meantime, if you have any questions, please reach out to me.